Hello, everybody. Welcome to the TraderMerlin Show. It is your Tuesday edition. Happy Taco Tuesday. May the tacos and burritos be with you today. I will be enjoying mine later on at trivia, but that's not the topic for today. Today we're going to talk about something a little bit different. We're going to talk about the B.E.C.C report. For those that don't know, the B.E.C.C report is something that is put together by a colleague of mine. He's been talking about bonds, equities, currencies, and commodities for some time and the relationships between those asset classes. And as traders of any asset class, knowing how bonds, equities, currencies, and commodities are moving can give you a potential competitive advantage, at least understanding the mechanics of it all. Interestingly enough, to pile on top of that, we have a situation where inflation is starting to potentially rear its head. That's what everyone keeps talking about. We'll see what Scott has to say about that. My guest today, joining me from, I'm going to say, the central, well, he's from the great state of Texas today. We got Mr. Scott McCormick joining us. Scott, how you doing?
Good afternoon. How are you?
Wonderful. Great to have you back. I just realized it has been 2 months since I had you on. I thought you'd be on much more regularly, and here you are just 2 months. I don't know if I can do this infrequently stuff, man.
I was going to say, man, it's your show.
I know. I just always hate bugging people to come on the show, but you always have so much to talk about, not just with these 4 topics, but also what you're doing from a Trading Academy and many other things. So anything new in your world you want to start off with before we dive into the fun?
No, just, staying busy, keeping an eye on the markets, trading here and there, and, just staying busy in the morning, working on the mastermind grid, doing the GPS or the guided pathway sessions every day
and
the daily market overview. And so it makes for a very full day.
It absolutely does. I'm sure that my viewers that are enjoying the daily market overview and the mastermind grid, thank you immensely. For those that don't know, he puts together with his team supply and demand zones. What you have 3 supply, 3 demand generally for 35 assets now?
Yeah, it's grown quite a bit. So I work on the equity side of things. So all the ETFs that you see in the grid is my responsibility, and we added the XLI and the XLB just this past month, which are the ETFs for industrials and materials. And I've petitioned to have staples and utilities added, which, those aren't necessarily, the most actively traded products.
Right.
They're pretty low beta. But when you take a look at being able to, round out a full portfolio, staples and utilities can be a part of that, and certainly at some point, they probably will be a little bit more attractive to investors.
Absolutely. Well, I mean, you look at any sector rotation model, there's generally 11 different sectors in there, and staples and utilities are a big part of that. So nice. Glad to see more being added to it, although I know that's a lot more work for you. Glad that you're doing it, not me. On that note, I certainly want to, before we wrap up today, talk about the inflation side of things. But I think it might make sense to run through your perspectives of those kind of 4 asset classes: bonds, equities, currencies, commodities. I'll do my best to drive over here on the platform. So if you have something you want to show the viewers, let me know and I'll bring it up for us. But let's start with the bond markets. We've obviously seen those yields, at least last week, took a really nice little drop, a bounce up today. Let's start with the bond markets.
Yeah, so we've talked about interest rates before. If I'm not mistaken, going back into November last year, because for those of your listeners that aren't too familiar with the bond market, it's probably important for them to understand that bond prices go up, interest rates go down, and vice versa. As bond prices go down, interest rates will go up. And so we saw a very interesting situation first quarter of last year as the markets were kind of responding to COVID and trying to hedge some of the risk. Some money had moved over into the bond side of things. So a lot of the times whenever the market seeks safety, they'll go over into the government treasuries because of the liquidity and the safety.
Yeah. And for the podcasters out there, if he says the first quarter was interesting, I'll put interesting in perspective. We went from roughly 2% on the 10-year, we're about 1.97, all the way down to, I'm going to say, it was a 0.36. I want to make sure I get that exact low there. Yeah, 0.36 was the dead low. I would say that's pretty interesting when you fall that quickly. I mean, over 1.5% in a period of about 2 months. That's pretty incredible.
Yeah, and really kind of the last time that we had seen that type of acceleration was going back into like 2008, 2009, the lows going into 2009. I mean, it was a cliff that you basically fell off of. And there's been times throughout history other than that, where we have. But whenever the markets respond quickly to news events, especially when there's a lot of uncertainty, sometimes, pardon the phrase, it's throw the baby out with the bathwater. Sell first, ask questions later.
I thought you were going to say something bad. Throw the baby out of the bath. That was like so PG. Come on, you should see some of the crap I say on this show. Wow. All right, back to your pew. Okay.
Yeah. So, the way that I look at interest rates is two different ways. One, whenever I go through the Beck report, I'm looking at the trend on interest rates going back as far as I can. As a matter of fact, I just did the Beck report for the Baltimore and the D.C. centers last week. We did a Zoom session, and one of the things that I pointed out is that I will start off this process looking at monthly charts, and I will go back as far as I can. Now, the platform that I typically look at for this is TradeStation, and they have interest rate data that goes all the way back to 1962.
Oh wow, you got me beat. I have right now for you on the screen up to 1981, so I'm missing out on 19 years of it. Sorry.
Well,
or 12.
Well, at least it's still in 1981. That's still a valuable kind of place to kind of gain or kind of get some sort of sense as to where we have been, because in 1981. That was a few months, depending upon what part of 1981 you're in. But we saw a top in interest rates in the third quarter of 1981, so October, November, fourth quarter actually. And from there, it's been in this multi-decade downtrend.
Yeah.
I mean, it's been nearly 40 years. So when looking at just interest rates alone to kind of gauge inflation, we've been at higher levels than where we are right now. We've actually seen interest rates go up more than what we have right now. Nobody was really talking about inflation back in 2016 when interest rates went from 1.3% on the 10-year all the way up to 3.2%. Over the span of just a couple of years. So when I'm looking at this, key thing for me is going to be seeing a break in this long-term downtrend. And the fact of the matter is, and this is purely my opinion, our economy is a consumer-driven economy. The Federal Reserve is still in a position of trying to really kind of get a better or fuller recovery than what we've seen. We have a situation where the velocity of money is at decade lows.
Right.
So until we actually see interest rates climb north of 3.3%, 3.25%, until I see velocity of money really start to tick up, the prospect of hyperinflation like what we saw during the 70s going into the early 80s, I don't really think is something that should really be of great concern at this point.
At this point, right? And I think these lines may have been on here from last time you were on the show, and it's interesting. If you look at the daily on this, and I'll go back to that time frame just so the viewers can see it. I'll put a full screen for everybody. Look at that daily. You're thinking, good God, this looks epic from inflation perspectives. And yeah, the yields are rising significantly on the 10-year. But if you go back to historical trends, which again, we'll bring up that monthly, it really does paint that picture. And this is why I'm always saying that trend is your friend to the bend at the end. It's such a cliche, stupid thing to say, but it is absolutely true. While we can be playing these fluctuations within that bigger downtrend, it's the power of the big one which leads. And I am with you. I do think that the trend will be lower rates. It does, obviously, we had that talk track about going negative for some period of time, although we are seeing for the first time in several years, all of a sudden, some strength in the yields, which is a a normal thing. It's that ebb and flow of price action. As you guys can see on the hard red edge of this chart, we haven't broken above that 2% mark since mid-2019. If we get above that, that still doesn't mean that this trend is done, but it is saying that obviously it's getting stronger. And if we can get above that 3.26, 3.3 mark that Scott was talking about, which is really that high from, call it, late 2018, then all of a sudden we might have to reconsider and think that this trend could potentially have reversed and start seeing some move to the upside. So I just want to throw some visual context to that as well.
Yeah. And so, the one of the other things that when it comes to inflation, I mean, obviously, there's three different types of reports that the Fed's really taking a look at. They're looking at the PCE, they're looking at the CPI and the PPI figures. And the CPI and the PPI figures are typically the ones that most consumers have kind of heard about. Mm-hmm. And, they break that down into two pieces. You have, X food and energy, which tend to be the more volatile, and then of course you have everything, mm-hmm. right? So when you look at the core CPI, which is, it's measuring everything, the change in the goods and the services that the consumer pays, excluding that food and energy. And what's kind of interesting is that, when you take a look at the charts there, and I have a chart just from Forex Factory that's going back to 2000, which I think is about as far back as it can go.
I'm going as quick as I can to bring up core CPI for the viewers at home, just so we're on the same page. But okay, keep going.
So in looking at the core CPI figures, we've kind of come in pretty hot here the last couple of months. This is kind of the highest levels that we had seen in the last couple of decades. Now, when it comes to inflation, and I was kind of having this conversation a little bit this morning inside of the guided pathway session. Obviously, again, we have a consumer-driven economy. So when it comes to inflation to a certain extent is good, because what it's actually showing you is that the economy is actually healthy and people are, you see prices actually going up. It's the rate at which it goes up that becomes a major concern.
Right.
Now, the other part is the consumer's ability and willingness to actually pay for those higher prices. And if we see a situation, for instance, we had the PPI figures come out this morning, and those were elevated, right? So producer is paying for labor, they're paying for all of these raw materials that are going into manufacturing. What they're going to try and do is basically pass those costs off to the consumer. And if we see that the PPI and the CPI are basically going up, and people are still paying for these goods and services, I wouldn't be too alarmed until we actually see things such as your net profit margin and your earnings actually start to decrease for these publicly traded companies.
Now, I love that you pointed out. Let me real quick. So I've got the
Sure.
PPI up here for viewers, and just so I know we got podcasters that can't see the screen, the previous producer price index number was 0.6% increase. Again, that's month over month. The expectation was we're going to drop just 0.1% to positive 0.5, still showing an increase in PPI, but nothing outside of the norm. Actually, maybe it is a little bit higher than the norm. The actual number came out at 0.8%. So we were certainly much higher than expectations. And as you can see on this chart here, this goes back the last 6 months. We've pretty much exceeded expectations every month for the past 6 months, and in some of them to very good measure. You can see that one spike about 5 months ago, and we were up right around 1.2, 1.3% for the month. That's a pretty sharp spike. So it's not saying. I think what we're getting here is the Fed is saying transient inflation. And you'll notice that we have had spikes historically going back. I only go back to 2013 on this price chart. But there are certainly quite a few bounces above 0.5. I would say you try to keep everything down below 0.5. That runs you about 0.2 or 2% per annum. At this point now, we're looking much higher than that at 0.8. And it seems like there's some regularity of staying above that 0.5% mark. Is that concerning to you because we have had consistently above that 0.5% increase per month?
It's so far, but this isn't the first time that we've seen this.
Right.
You know,
right.
You have to, like, if you go back to, I know you were just saying you were looking at 2013, and I have the PPI month over month chart that I'm looking at. Going back into 2010, 2011, you know, we saw that those rates were let's see, 0.2%.
Are you on core or the regular PPI?
I'm on the PPI.
Okay.
Just straight up.
Yes.
But they went from 0.2% to 1.6% back in 2010 through 2011.
Right.
And that was pretty consistent there, with the exception of maybe 1 month in February 2011, before we saw that spike in March, and then it started to tail off.
Mm-hmm.
So, and if you were to go back into 2007, it was up at 3.2%.
Right. Yeah. Huge. Yeah, and I think that's the great point here is put it in context, right? You look at, if you just looked at the last since 2013, it's like, oh shoot, this is starting to get a little heavy. But you look at some of those spikes we had in 2006, 2007, 2008. I mean, some of those were up over 2%, and that is much higher than where we're at, which I think is why the Fed is saying, oh, it's transient, because we're not seeing any significant spikes. Now, that said, the PPI looks smooth if we go back that far. Let me go back to the CPI numbers here, because the CPI had a much more smooth look to it. I'm going to core. I guess I could go to regular CPI. Let's go to regular CPI since we're calling apples to apples here. If you look at it here, this goes all the way back into 2000. You can see that while we have seen on the right-hand side of the chart here steady increases, we have had this before in the past. All right. Now, if we're talking about inflation here, and you looked at CPI, we talked about PPI. You and I were talking before the show. It's like, how come this is becoming a conversation of topic at this moment in time? Because I look at something like the B.E.C.C, which is a commodity ETF out there. Here is the monthly chart of it, guys. It's you can see it's had a monstrous run since 2020. And to put it in perspective, let me just show you the exact percentage that this has gone from the low in March of 2020 to where we closed at today. Not even going peak to peak. It's an 82% gain. Remember, we're looking for 2% inflation. This is 82% in less than 2 years. This is just over a year and a half. Not even a year and a half. So, I mean, how come we're not, seeing CPI numbers just skyrocket if the commodity prices are spiking like this? And is one of these a lie?
Yeah, so I'm just going through, like, one of the first things that I do when I think ETF is I want to know how it's broken down, especially in any index in particular. It doesn't matter if it's an ETF or if it's an actual index.
Right.
But when you take a look at how this is built up, most of it is in, it looks like here, government short-term investment grade government and agency bonds. That's like 24%
of DBC.
Right? Yeah. And then from there you start to get into the different products. And so the first one, which is 7.3%, is crude oil.
Yeah.
Right. So you start to look at charts that are moving up astronomically or appear to be moving up astronomically. It shouldn't be too much of a surprise if you were to overlay like a chart of crude oil with the DBC. They're going to look very, very similar. The only difference is that DBC is making a new high versus those highs in 2018. Other than that, they're identical.
It's funny and I'm glad you brought that up, because I just brought up the whole constituents list of that ETF, and it's funny. I got my viewers hear me say this all the time, where it's like you have to look at each ETF for its actual composition, because you think, oh well, this ETF says it does this. When you look at the DB Commodity Index Fund, which is DBC, there's tons of stuff in here that's not commodities. I mean, I look at it. You mentioned U.S. Treasuries. I mean, there's 10, 20, 30. You got 50% of this. 54% is investment grade bonds. Like, wait a minute, this isn't a bond fund. Well, it actually could theoretically be a bond fund given how much Treasury bills are in here.
Yeah. So, and just kind of looking at the description, they're trying to have exposure, and this is in the order in which they listed, right?
Right.
Light sweet crude oil, heating oil, RBOB gasoline, natural gas, Brent crude oil. So, the first 5 products there are all energy related, and then from there you've got gold, silver, aluminum, zinc, copper, corn, wheat, soybeans, and sugar.
We're missing my lumber, man. We're missing lumber.
Yeah. So, when I see, any type of index, I always look to break that down. And when you start to go through and you look at, what I refer to as kind of economically sensitive commodities. So when you do look at crude oil, obviously over the course of last year, we've seen it go from negative 40 in April last year, but according to the continuous contract, it's gone from like 8 up to 72.
Yeah.
So it's like a 900% move.
Yeah. That'll skew any index.
Yeah. And then you start to get into, we were just talking about copper before the show. Copper has more than doubled in value over the course of the last year. Now, in these situations, again, anytime you start to look at raw goods, physical commodities that are actually being used in production, obviously the increase in the materials is going to impact the companies that are using them. It can start to eat into their profit margins. But again, the question is are they able to pass that off? And that's basically going to be representative of demand within the economy if they can.
Right.
Which takes me back to one of my earlier statements, which is so long as there's demand, then I don't think the Fed is going to be too concerned because it's representing the fact that there is some health to the economy. So what they don't want is the hyperinflation. Right. But nobody was really screaming about hyperinflation when copper went from $1 to $4.53 over the span of 4 years. Yeah. Not that I remember back in the early 2000s.
No, it's really become much more recent that the hoopla has been around inflation, and I don't, I personally see it every single day I go to the store. It kind of blows my mind that they're saying it's transient, and I mean this price of everything that I'm getting it's just gone up. It's funny, I was joking like I love In-N-Out Burger, one of the luxuries of living in California. Got a number one combo with cheese. I think it was $6.80 in January of 2020. It's now over $10.
Is it really?
I was like, "Are you kidding?" I just went. I was blown away. No, wait a minute. No, I'm sorry. That was Habit. Habit was $8, and now it's over 10. I think In-N-Out is in the 9s, but still, I mean, that's a 30% increase or 50% increase in cost passed on to me, the consumer. There's no inflation. It's transient because I'm sure that the cost of my number one combo meal at In-N-Out Burger is going to go back to $6 at the end of all this.
Yeah, it's never going to go back, because here's the thing. Even if the price of the goods that they're using to put into your final product actually drop, there goes their profit margin. It's just going to increase. They're never going to do that.
Right.
I remember I used to be able to buy a bottle of Pepsi for 99 cents from the store. Now it's $1.76. So don't get me wrong. There is inflation out there, right?
Yeah.
So. The question again comes down to the consumer, and a lot of that, this has come up quite a bit recently in the news about people not going back into the workforce simply because they're able to get more from government assistance than what they would through their regular wage. So I think that there has to be some sort of shift to make sure that your employer, or not your employer, but your employee, and ultimately the consumer and the economy is in a better position to be able to financially handle all of this. Because if not, then you're going to have bigger problems, and it won't be pretty when it happens because again, 70% of our economy is based on consumer spending,
right?
And
on that note,
strong consumer.
Yeah, on that note, let me show a graphic up here. I know you can't see this, Scott, but it's the retail sales numbers from today, and the previous month-over-month retail sales was an increase of 0.9%. That was a decent increase. The expectations were we're going to drop to negative 0.6. So they're really expecting there to be about swing to the sell side, and a large part of that is due to no more stimulus checks and unemployment benefits being cut. The actual number came out at negative 1.3%. So we're worse than expectations. And I have that graphic here just so you can see that it's not the end of the world that we're negative 1.3%, right? It's really when we start to connect these dots, how does it look, in 2, 3, 4, 5 months from now? And I think this is really, for me, interesting because if we look at what's going to happen tomorrow, the Fed will be having a meeting and making a rate statement and coming out with a press conference. Full disclosure, I bought some puts on the S&P today. I bought puts on the NASDAQ. I bought puts on Amazon. I bought puts on eBay as well. So I'm expecting there to be more inflation chatter, especially since, as Scott just said, and I think we all know this, the U.S. is a consumption economy. We spend money. It's what we're damn good at. If we can do it on credit, even better. And now the retail sales numbers are off so big, consumer income has dropped as well. That could be one of these pieces that starts to change spending habits here, and people don't pay those inflated prices, and then we start to see problems going forward.
Yeah, because again, just kind of looking at a chart of the retail sales figures historically, again, going back into 2000, last time we saw, retail sales down around this level, with the exception of 2020, was back in 2008 during the recession going into January 2009, and of course back in 2001 as well. Mm-hmm. Now, do I think negative retail sales, just this one report, is going to turn into a bear market? No. Because it's, in many states, they're still in the process of reopening. As businesses kind of get back to normal, I'm going to go so far as saying that in another year from now, we're going to be closer to what was normal compared to where we are today. And, of course, time will tell, and it's just prognostication. But, as new data points, new data figures come in, it's always important to take that new information in, to use it in a way to help you make a more informed decision.
Sure.
Because conditions change.
Yeah, and everything is an opinion until proven wrong. A lot of the stuff that, I can see Big Eb going, puts again in the S&P? Yeah, it's okay. It's fine with me. I'm okay to take that kind of risk. I know some people on Scamwell's going, I'm kissing the devil, I'm being stupid. And you know what? I'm putting my money in my market, so feel free to put your money where you like. I'm just telling you what I'm doing. So being transparent, if you will. On that note, let's talk about currencies. So one of the ones that I think is obviously a major factor for our economy, on businesses on all level, from tourism to actually manufacturing, etc., is that the U.S. dollar, the dollar index. And we've seen that kind of stuck around that 90-ish mark, but it tried to rear its head a couple of times over the past few months, has not been able to get back on its feet. I actually thought for a second we were going to see a nice little rebound here. But it's stuck around that 90 mark. Any take on the U.S. dollar?
So we follow that very closely in the mornings in the GPS session, with the exception on Mondays. I cover it every day, and more as a service to our students than anything else. Because when you look at currencies, one of the first things to remember is that it's all relative. The dollar index itself, again, being an index, you have to know what it's built of. It's made up of 6 currencies, starting with the euro, the yen, the British pound, and then going down into what I'll call the bottom half, which is going to include your Swedish krona, your Swiss franc, and the Canadian dollar. It's not that those are less important, it's just the way that index had been weighted. The top 3 currencies make up something like 83% of the dollar index, and when you look at the top currency is the euro. I want to say it's in around like 51 to 57%.
Yeah. So
it comes down to what interest rates are in each one of those environments, which is part of the reason why central bank announcements like what we're going to have tomorrow, like what the Eurozone had last week, what Swiss Bank is going to be having here in the next week. All of that becomes relative. If our interest rates are more attractive than theirs, money is going to basically rotate into U.S. dollars because they want to buy our bonds, and vice versa. And so when I take a look at the dollar, what I've seen here is that the longer term trend, and again, I'm going back into 1985. Okay,
I'm right there with you. I got it right now.
yeah. So if you go back into 1985, you had two major peaks there, one in 85 and one in the mid or early 2000s, and we broke that trend line going into 2015, 2016, and since about 2018 or so, 2016 rather, we've been going sideways in this fairly large range between that 102 area and the 90 area on the low side. So we've been bumping up against this area of demand in around that 90 to 80 spot. And currently what I'm looking for is basically a break above the highs from what we saw back in April of this year at about 93. If we get the break on that to the upside, then my forecast is to first come back up to about that 102 area. And then if you break out above that, just a very simple measured move would be to take the height of the range that we've been trading in for the last 5 years and project it from the top, which would actually take you back up to about the 118 area. And there's a monthly supply zone up there too, between 116 to 120. If for whatever reason we break down below this range, below that 80, I've got my first demand zone down around 81 to about 78. But again, I'm a big fan of measured moves. So you break out to the upside, you can move in equal distance. Same thing's true if you break out to the downside, in which case you're probably coming back down to the lows there in 2011 between about 74 to 73. So in looking at that, again, and kind of going back into the conversation about inflation, right? When you take a look at what's happened to the dollar index basically topped out there in 2016. And usually a weak dollar is beneficial for stronger commodities. And if you go back into some of the commodities markets, starting off with, let's say, gold, gold bottomed out in late 2015, but we saw a really big push beginning in August of 2018 going into the highs of last year. When you take a look at crude oil, obviously we all know that crude oil bottomed out last year, and there's much more supply and demand issues there, for crude oil, simply because you have OPEC that's basically trying to.
What, you tell me there's no gold cartel? Come on, there's got to be a gold cartel somewhere. The zinc cartel,
and then taking a look at copper, again, copper had a major bottom last year, and obviously it's doubled in value over the course of last year. But prior to that, it bottomed out in early 2016 and had a push higher to about 3.5. And then you start to take a look at soybeans. I know a lot of people are like, soybeans? Yeah, soybeans. It's like soybeans are used in all sorts of goods. And, this is something that has gone from 783 in 2020 all the way up to 1653. And then taking a look at things like corn. Corn had an incredible move last year from 294 all the way up to about 733. So my point here is that if we do start to see a strengthening dollar, then it might actually put a little bit of pressure on these commodities. So it's not to say that they'll collapse or that they'll go down at all, but they might go up at a slower rate than what they have been. Mm-hmm. And again, a lot of what the Fed looks at is not necessarily whether something is going up or going down in value. It's the pace at which it's going up or down.
Which is concerning for me with these commodities right now. I mean, you talked about corn, and I've got the monthly up here. Let me switch it over to weekly. It looks a little better when you take some of the slope out of it, but still from July of this year, corn has had a huge run up. You look at lumber. Lumber is really interesting because how much it's come back down. It's dropped over 50% in the last 5 months, 5 weeks. Phenomenal, but still, trading at 1,000 versus where it was in March, which is rather under 300. it's still up significantly. And you talked about soybeans, similar picture, guys. We're at 850. We're currently at 1463. These are all pretty accelerated moves. And you just mentioned that the Fed is concerned with the speed at which things are changing. Then why aren't we hearing more from them, in your opinion? Sorry, I didn't have my charts up there, guys. Sorry about that.
No, it's okay. I again, history, and this is part of the reason why I like to look at monthly charts. When I go out to like the soybean charts, yes, soybeans, they hit an all-time high. Copper hit an all-time high. But this is not the first time in history where soybeans have gone up this fast.
Sure.
And I think part of what has also played into the price of soybeans, has been the trade wars with China. That's still been a bit of an issue there. So
it's funny how that disappeared, didn't it?
Yeah, I know, right.
It was a Twitter topic every week. It was like, deal with China, no deal with China. Deal with China, no deal. Now it's like, is China still around? I haven't heard from them in a while, except for Wuhan.
There's headlines on China now. It doesn't really matter what the administration is, but as I take a look at corn, again, the longer term trend that I see on corn, going back to 1974, 1974 is trading at 1361, and here we are at roughly half that. But back in 2010, it went from 468 all the way up to 971, so it nearly doubled there.
Yeah.
And then from there, it fell from 981 all the way down to 292.
Right.
Nobody was complaining then, except for maybe the farmers. But that was corn.
Hey, if hedged properly, they weren't complaining at all.
Exactly. Not to mention that most of the farmers are actually subsidized by the government anyway, which is why they look at non-farm payroll. So anyway, why is the Fed not as concerned? Because I think we're just at levels that don't show signs of that hyperinflation.
Yeah.
Not yet.
Time will tell, right?
Now, again, do I like paying higher gas prices than what I was, 3 years ago, 4 years ago? No, I don't. Nobody should. But again, I'm trying to be as agnostic here as possible and let the market just tell me what to do.
Yeah.
That's kind of the biggest thing. And you kind of alluded to it earlier. The way that I always say it is that, the only thing I'll ever know when it comes to the market is where I'm wrong. And what I see right now is that, with the exception of, I'm staring at a chart of corn right now. Long-term trend is down, short-term trend is up. When short-term, right, over the last year, but long-term over the course of the last 40 years. And I think that that's important for your listeners to understand. The Fed does not operate on a week-to-week, month-by-month basis. They're looking out years.
Right.
It used to be that the average economic cycle was about 48 months, right? Due to all the quantitative easing that took place in the last decade, that has now exacerbated this. We technically are still in that expansionary phase. There was a bit of a slowdown, I believe, back in like 2015, 2016. But when you consider the fact that we've been in this equity bull market for the past 12 years, and we have not really seen a slowdown in that yet. And the fact that typically the S&P 500 is a proxy for the economy. I know a lot of people say, well, the market is not the economy. That is correct. That is a very true statement. However, that index tracks 70% of its domestic companies from the United States. So you can't tell me that if you have 3M, who's producing a wide array of goods and services, if they don't start to see a slowdown in the economy, that it's not going to affect their stock price.
Right.
You can't tell me that. So I like to look at the markets as kind of a gauge, a bird in a cage that I'm taking down into the mine with me. It's that canary in the coal mine. If I start to see weakness in that, then I will be a little bit more concerned about the longer term prospects of the economy. And when I follow the market, remember, I'm looking at a monthly chart, and the monthly chart that I have right now is going back into 1965, and the level that I'm watching on the S&P 500 to really kind of say that, hey, you know what, this long-term trend that we've been in since 2009 is broken. We have to get down below the lows of last year.
Yeah,
we would have to see this market decline nearly 50% to prove that the long-term trend is done.
Yeah.
Right? Now, for those listeners that are like, oh my God, you mean to tell me that I've got to wait 50% decline before this thing goes any further? Well, there are hedging, right? There's ways to hedge, but from a longer term investment perspective, and granted, hindsight's 2020, but last spring was one of the best opportunities to be a buyer since 2009. One of the things that I like to use is what's called the percent of stocks above their 200-day moving average, and this does not dip down below that value that often. It doesn't dip down below that 30 value that often. I say 2009, but there were some periods back in 2011. There were some periods back in 2016 and 2019 after that dip in late 2018, and where we are right now. And so, if you're looking at this market and you're thinking, well, I should buy and just dollar cost average in, okay, don't put all of your money in there. But when you're following kind of those short-term trends, there's ways and levels that would indicate that, hey, we're kind of slowing down. So for me personally, right now it's at 40.52 on the S&P. So if I saw, for instance, like a monthly close down below that level, that would kind of be the warning to me that, hey, we're probably going from this intermediate uptrend to an intermediate downtrend. So don't be a big buyer here. And if that intermediate downtrend continued until it got down to, beyond that 2200 area that I was just talking about, then all right, cool. Because if I'm sitting in cash, or if I have some sort of bearish position on during that period in time, during that correction, then I'll continue to hold it until that trend reverses.
Sure.
And I know that might sound very simple, but it is. It doesn't have to be complicated.
No, simple's the best, man. The longer I do this, the more I realize that simplicity is the way to go. I had one question that came in from a viewer yesterday, or actually last night on the YouTube channel, asking when you're going to be doing core strategy class again. You got any classes coming up here, or are you just?
I do not have anything scheduled as of this point in time. I've enjoyed my sabbatical. Let's call it that. Because it's one of those things where my schedule, I get up at 4:00 in the morning and I work for a solid 2.5 hours for Online Trading Academy, prepping all of the grid, the daily market overview, going into the guided pathway session, and then after that is my time in front of the markets, and I'm generally pretty fried, even by about 10:30, 11 o'clock in the morning. It can be pretty exhausting to be me. So I don't feel that I would actually be of any value inside of a classroom, because by the end of the day, I would be so loopy.
They'd have to find someone else to do that for you. But it would be great to get you back in the classroom. You're like me. We kind of come alive when you're in front of physical live students, because it's it's just rewarding to see people get it and engage with them. So
it is. It's very different. It's very different. And I have done some special XLT sessions here and there. As a matter of fact, I've got one that's coming up this Thursday,
5 p.m. Eastern Standard Time. Lisa just posted it in the chat. Thank you, Lisa.
Yeah. So I am looking forward to that, and I've done a couple of those back in like February, March. I did one last week, so I do have my opportunity to kind of get in there and kind of get a little bit deeper than what we normally would inside of the classroom, and that really kind of excites me, especially with my background. I can get deep into the weeds pretty quickly. I used to warn students inside of the classroom, you got to be careful with me, because if you take me down that rabbit hole, you won't come back.
Well, I've always appreciated your nerdiness, and I guess that's why you have that CMT. I couldn't hack it. I couldn't go through the 3 levels of that. But but I'm glad that you did because you get to come on and share that knowledge with my audience. So thank you so much.
It's definitely fun. I found value in it, and I'm glad I did it because, it one way or another led me to doing the Beck report, and it doesn't matter what you call it. I think one of the key things that I tell people whenever they ask, what's the Beck report? Well, what it actually is a process for putting the markets into context. And I look at everything, when it comes to investable assets, because at the end of the day, if you're going to have your market in those investable assets, wouldn't you want to know what they're doing and where they can go and what the possibilities are? And to me, the only way to do that is to really have kind of that broader perspective.
Yeah. Well, thank you. I appreciate you coming on, taking the time. I know you're exhausted, so
Thanks
I'll let you go back to sleep and get ready for your long day tomorrow.
Yeah, full disclosure, I was taking a little nap on the couch about 30 minutes before you'd ping me. So
that's why we can't use video, guys. He's got pillow marks on his face right now.
Yeah, it's 100 degrees outside, but I'm sitting inside of my house with my hoodie on. So
nice. One last question before I turn you loose.
Sure.
Gary just sent this in. He said, can you discuss CMT more? Real brief. Like, how long did that take you to get those credentials?
So I have a very interesting history with the CMT program because I actually took a couple of years off. There was an interruption to my employment in the financial services industry because of reorganizations that Schwab was going through back in 2002 through 2004. But all in all, it back then you could only test once a year.
Oh, wow.
So I took my level 1 exam in the spring of 2002. I then took my level 2 exam in the spring of 2006. After that, I took my level 3 exam in 2000. I want to say 2000. Yeah, so it had to have been 2007, and then after that, they actually started running the test twice a year. So my level 3 exam I had to take 3 times.
Wow, really?
Yeah. So a lot of that is kind of on me. So the first time, I made the mistake of not double checking the reading list because it used to be that they would have specific books that were written by specific authors and specific chapters that you had to study for each of the exams. And one of the things that I noticed was that the reading list really wasn't changing that much up to that point. But it just so happened that they added a book, and when I got into the exam, there were about 5 or 6 questions that were from this one author in particular, Robert Shiller, Irrational Exuberance. Mm-hmm. And I just simply did not pass. I couldn't answer those questions. And then the second time I took it, my questions or my responses to some of the questions were a little too fundamental in nature. I talked more about what more of the macro impact would be as opposed to getting into some of the specifics that they were looking for. But the third time was the charm.
Nice.
So fortunately, they were able to, have someone go through, review my exam to kind of explain to me. It's like, okay, this is why you didn't pass. So it allowed me to kind of focus more on the third one. But today it's very different. And from what I understand, a lot of the same topics they are studied, but there's much more emphasis on the quantitative side and the statistical side of things than what there used to be. The materials are a little bit more like the CFA program now, where you have your exam fees and material fees, but you get books from them, as opposed to having to go to back in the day, Books A Million or Barnes and Noble and make sure that you got all of the specific books. So I have a nice small library here today, and sometimes I'll open it up and crack it open, But it's I found a great deal of value to it. To actually earn the designation, you do have to be employed in the industry now. Fortunately I was, but you have to have at least 3 years worth of industry experience, either on the wealth management side or the analysis side or proprietary trader, something along that line. But anybody can become an affiliate of the CMT Association. You can go in there, get the reading list, study the material. You can attend the meetings. So there's all sorts of valuable information there.
Nice. Well, I've got it up here, but I'm sure some people will be interested in checking that one out. All right, man. I'll let you go. It's been a long one. Thanks so much for our
Sure.
Beck report for the month of June. Hopefully, we'll get you back on in July, see if we get any updates, and see if inflation has you worried. And one of the things I was curious to ask you about is like what's going to take to freak you out. I'm hoping one of these days to get you on the show, and you're gonna be like, "Holy crap, Merlin, I am freaked out." Then I'm gonna be like, "This is some good trading coming, boys. Let's go."
Yeah.
All right, man. Well, hey, have a good one. Thanks for coming on. Appreciate it.
Sounds good. Thanks for having me.
Bye. All right, guys, that was Scott McCormick giving us some insights into, a lot of different things there. Beck report, bonds, equities, currencies, commodities. We kept it very high level, and just for Big Eb. And, Tom, I did not mention the third C word one time, nor will I on today's show, just to get you guys. So you always think I always talk about that stuff. Not going to happen today. I do want to get something real quick for our Chelsea fan from New Jersey. NJ sent in a contribution asking me to look at Activision and look at soybean meal. Interesting. I don't usually look at soybean meal myself, but here is Activision, which I do look at regularly. I have not been really entertained by it lately simply because for the better part of 3-4 months, it's just been chopping sideways, albeit in a $10 range. And he says, going long, entry at 94, target at 110. So you're looking at making a $16 profit on your trade. Not bad. I'd be surprised based off what I'm seeing here if it actually got down to that level. Although it happened real quick today. You are making this just for the better part of May and June. It's in a nice little uptrend, bounced off 94. We'll see how this comes down. Sure, I would take a stab at it at 94, but what's interesting for me, NJ, in all of this is on both of those trades you sent in, you have your entry and you have your target. You realize that target's not the important part, right? It's the stop loss. And the question for me would be if you went long Activision and you said your target was 110, let's put that into perspective too. To get to 110, that's off the charts. So to ignore this spike that you saw in February, this peak that you saw in February at right around 104, you can't ignore that. All right, that's going to be a challenge for this no matter what. So now all of a sudden you have to change your trade from I'm going long at 94. My first target's going to be, let's say, 104. So I got $10 profit there, and then maybe I'll let the second half run to 110. So that's how I would change this one. You certainly cannot avoid this peak that happened back in February. And then let me zoom out a little bit and see if I actually like the 110. Go back to a monthly here. Oh, so you're just doing some projections because this is all-time high. So yeah, that's a bit more speculative on what we need to do. But once you get above that 104 mark, then yes, you do have blue sky above you, and it could probably move fairly fast. So I'm okay with that one. On the other side, you asked me about soybean meal. And I don't quite get the levels on this one, NJ. You said entry at 340, target at 420. So you're basically looking to buy this sell-off here. And for me, I'm just looking at the picture here and saying, if it gets down to 340, it's broken below these lows of 394. It's also going to break below these lows, which actually would have been a buy point for me, kind of right where we're at, right around 375. So now to me, it's actually starting to make some new lows. I would actually be more inclined to think about shorting it just off basically this trend that's happening right now because it's been aggressive sell-off and it's making new lows. So trying to catch it at 340 is, to me, catching a falling knife. I'd go deeper just to absorb some of that risk and maybe go at 334 as my buy point. And if you were to buy at 334, you have to wait and see what this picture looks like once it gets there, because you might have some new supply zones established, and that could dictate the way that trade is going to be going. So anyway, there you go. No, hey, thank you. I appreciate it, NJ, very much so. Nope, I can't even mention. You guys are on me going into those digital currency things I keep hearing so much about. We're not going to go into that today. Let me go into what is happening for mañana. We already talked about the stuff that happened today. Certainly the PPI numbers for me were pretty concerning, and retail sales I think was pretty concerning as well. Medic, you're probably right. I was thinking he's talking soybean. When I see ZM, you're right. Yep. Zoom. There you go. That would make more sense. Let me go back to this. Thanks, Medic. You caught me on that one. I was thinking, well, I don't really see any levels here that look good. But let's go ZM. And put those same lines on there. Man, you guys saved me today. I was like, well, Okay, let me go back there and get the numbers again. So 340 is one level that you're looking at. 340, boom. And then the second one was, of course, the magic 420 number. Okay, so for Zoom, first off, I'm not bullish on Zoom really in any way. I'm overtly bearish on them just because I think they got a ton of competition coming into the space, and what their model is easily replicated by big companies like Amazon, Google, Microsoft, and so on. And you can see now Microsoft is doing a big push, albeit Microsoft seems to fail at almost everything they do. Let's remember they had that thing called the Zune for a while. But if we were to take this and go long at 340, I would probably go lower than that, because if I'm looking at the daily here on Zoom, I don't see anything really here that's of interest at that price point. I'm probably going to drop down to, let's say, 334. Obviously, that saves me about $5 or $6 per share on the entry. Now the question becomes, where's your stop loss? And it's going to come one of two ways. If you're really risk averse, it's going to be just below that area where your entry is made at. As far as targets up there, yeah, I don't see it getting to that level. Your 420. You'd have to break these candles apart, but yeah, I don't. To me, the 420 looks like it's kind of sitting in the middle of nowhere. There are a couple of areas that will be of interest to me, and that's just kind of because the day opened there and aggressively sold off. Other than that, that's going to be the 383 mark, or even better, if you're looking at a long here, is going to be that 439. However, my question for you would be this: what is Zoom doing coming out of the pipeline that's going to cause that, right? They kind of were a one-trick pony. They're doing online meetings, social media meeting places, and now you have almost everybody else stepping up. So I'm wondering what will be the next piece to push this up, especially since we are now going maskless and all of a sudden people are getting back to work, so we can not have such reliance on these online meeting type of software platforms. So I don't know. I don't see the catalyst coming that's going to push it back up to that 440 mark or 420 mark, but hey, I've been wrong before, and it won't be the last time that I'm wrong. Okay, let's see. So hopefully I got that one, NJ. And Medic, thanks again for correcting me on that one. I saw the ZM and I was just stuck on futures mode, so I went to soybean meal futures. All right, yes, it's Mask Independent Day. I'm going to do the show without masks from now on. No, I'm kidding. Hey, you know what? I saw something from Gavin Newsom talking about how they were going to potentially have a digital card to say whether you've been vaccinated or not, which of course would be I'd be upset about that one myself. I have not been vaccinated quite yet, but we'll get it eventually. Okay, let's see. Tomorrow, no guest on the show. I did have a question that came in, which I didn't get a chance to get to. It was asking about Paul Tudor Jones' comments on the inflation trade, where Paul Tudor Jones basically said, look, load up on the inflation trade. So maybe we can talk about that. I am still short. I'm not short AMC, Pepe. I sold puts at $30. So the odds of me getting executed are pretty slim, but those are sold for Friday. So we'll see what happens. I was actually thinking about closing them today, but as it hit $60, I was like, is it going to drop 50% by Friday? It could, but I'll take that risk. So I'm still short. I still sold the puts on AMC. I do have outright puts on S&P, NASDAQ, eBay, and what was it? Amazon. But I just bought one on Amazon. I want to buy one next month closer to the launch date just to see, because those options are obviously extremely expensive. All right. Cool. All right, everybody, that's going to do it for me. I have no guest for tomorrow. I'm going to try to get a guest for Thursday's show. I think I might be able to pull one off. I got some interesting questions. I mentioned Bill Addis will be on next week. So if you have questions for me, easy thing to do is send them on in at TraderMerlin@gmail.com. That's the best way to send me questions, or post them down below the video there. You can on YouTube if you're looking at that. If you're new, which most of you are not, because nobody survives this long if they're new. It's only the regulars that are gluttons for punishment. Click that subscribe button or hit that thumbs up, and I'll see you guys tomorrow. Take care, everybody.